It was more aggressive than expected. We're talking the ECB's QE program this Thursday. Joining me now is Jim Wyckoff. Jim, good to see you again.
Hello, Danielle. Always nice to be with you.
Jim, media reports on Wednesday said the QE package would be 50 billion euros a month. Today it was announced it's actually 60 billion. So is it safe to say that the marketplace was not expecting such an aggressive or as an aggressive of a move from the ECB?
Daniela, the marketplace is still digesting the more stimulative package from the ECB than expected. The European bond markets were roiled initially. Last time I checked, they were rallying. The U.S. dollar index was lower early on, and it has rallied. The euro currency has sold off and is near a 9-year low. So yeah, the markets are volatile, and I think most market watchers have yet to really figure out what the ECB announcement is going to do on a long-term basis. On the one hand, the more aggressive package could be positive because it could mean a recovery sooner. But on the other hand, it also suggests the ECB thinks the European Union economy is in a bit more trouble maybe than many expected.
So, Jim, is it safe to say that the marketplace was definitely surprised and shocked by how aggressive of a move the ECB took? Did Draghi not have another alternative?
Yeah, Daniela, the markets don't like to be surprised, and I would call the a bit more aggressive move by the ECB a bit of a surprise, especially following media reports earlier this week that pretty much laid out the details that the package would be 50 billion euros instead of 60 billion. So, like I say, the markets are still digesting it, and I think at the end of the day, we might have a better idea of what the markets perceive this package to be. But right now, we're just seeing a lot of volatility, and this volatility and uncertainty in the immediate aftermath of the ECB announcement is favoring safe haven gold. Anytime you have uncertainty and anxiety in the marketplace, it's usually going to tend to favor the safe haven gold market.
Which brings me to my next point. Gold, Jim, we're seeing it fluctuate following the news. Does the current movement we're seeing in gold make sense to you right now?
Daniela, I think what we're seeing overall in the gold market is we're seeing continued safe haven demand. We're seeing an improved technical posture, and we're also seeing more money flowing into ETFs for gold. So all that is auguring for upside price action, and it's kind of feeding upon itself, and we're seeing gold prices at a 5.5-month high. We're really in a pretty good overall situation for gold right now.
So really back-to-back surprises for gold. Last week, we had the surprise move by the Swiss National Bank, and today we have the aggressive move by the ECB. So Jim, what is gold's mark for the week?
Danielle, I'm giving February COMEX gold a Wyckoff market rating of 6.5. That's probably the highest reading we've seen in a few months. Solid overhead resistance at the August 2014 high of 1323. Solid technical support at this week's low of 1272.10. Looking at March COMEX silver, also prices at a 4.5-month high. Solid uptrend in place on the daily chart, giving silver a Wyckoff market rating of 6. That's also the highest it's been in quite some time. Overhead resistance at $19. Solid technical support at the recent high in the previous month of 1735.5.
Well, it's nice to see gold and silver back with the higher marks. Jim, thanks so much. We'll see you next week. And thanks for watching Technically Speaking with Jim Wyckoff. We'll see you tomorrow.